Swayam Prabha. Digital India. Educated India.
Yoga Karmasu Kaushalam.
Hello friends, I am Professor Dr. Himesh Doshi from PD Pandya Commerce College affiliated with Gujarat University, Ahmedabad. Today we are going to discuss about joint venture accounts when a separate set of books is not maintained. Dear friends, in the previous session we studied number 1 journal entries in the personal book of a co-venturer when a separate set of books of account is not maintained. Number 2, preparation of joint venture account in the books of co-venturer. Number 3, preparation of other co-venturer account in the book of co-venturer who maintains books of accounts for the joint venture in his own books. We also discussed the accounting treatment of bill of exchange in the books of co-venturers. In this session, we will do the practice of how the ledger accounts were prepared in the books of each co-venturer when a separate set of books of account is not maintained in the books of the firm. Discuss which journal entries are passed in the books of co-venturers when the advance is given by one co-venturer to another co-venturer. Discuss how to find the valuation of closing stock when the rate of gross profit on cost is to be added without considering any expenses. Let us begin this session with illustration number 4. Ram and Shyam enter into a joint venture to undertake a building contract valued at rupees 12 lakhs. They provided the following details regarding the expenditures incurred. Particulars: Ram's expenses and Shyam's expenses. Material paid by Ram 3,40,000 and by Shyam rupees 2 lakhs. Cement by Ram 70,000, paid by Shyam rupees 80,000. Wages paid by Shyam only rupees 2 lakhs. Architecture's fee paid by Ram only rupees 40,000. License fee paid by Shyam only rupees 10,000. Plant paid by Shyam rupees 3 lakhs. Additional information: the plant was valued at rupees 1,40,000 at the end of the contract, and Shyam agreed to take it at the value. Ram advanced the rupees 5 lakhs to Shyam. The contract amount of rupees 12 lakhs was received by Ram. Profit or losses are to be shared equally between Ram and Shyam. The balance amount due to each other was settled. Required: number 1, prepare the joint venture account and Shyam's account in the book of Ram. Prepare the joint venture account and Ram's account in the book of Shyam. In this question, the new transaction is Ram advanced rupees 5 lakhs to Shyam. Let us first see which journal entry will be passed by both co-venturers. Ram gives advance to Shyam, so Ram will debit Shyam's account as Shyam is a receiver, and the bank account will be credited as the assets goes out. So Ram will pass journal entry as under: Shyam's account debited by 5 lakhs rupees to bank account credited by 5 lakhs rupees. Shyam is receiving an advance from Ram, so he will debit the bank accounts as the assets comes in and credit the Ram account as Ram is the giver. So Shyam will pass the journal entries as bank account debited by 5 lakhs to Ram account credited by 5 lakhs. Now let us solve these questions in the book of Ram, joint venture account with Shyam, debit side and credit side. Ram paid expenses, so to bank account material rupees 3,40,000, cement rupees 70,000, architectural fee rupees 40,000, total amount paid by Ram rupees 4,50,000. Shyam paid expenses, materials rupees 2 lakhs, cement rupees 80,000, wages rupees 2 lakhs, license fee rupees 10,000, plant rupees 3 lakhs. Total amount paid by Shyam 7,90,000. Now on credit side, by Shyam's account rupees 1,40,000, the plant taken by Shyam. On credit side, by bank account, contract price received rupees 12 lakhs. Now make total on both side. So total 13,40,000, difference on debit side rupees 1 lakhs. This is known as net profit. This profit will be apportioned among Ram and Shyam. So 50,000 and 50,000 in the ratio of 1:1. To profit and loss account rupees 50,000 and to Shyam's account rupees 50,000. Now come to Shyam's account. So let us prepare Shyam's account in the book of Ram. In the book of Ram, Shyam's account. Debit side, to joint venture account 1,40,000. Now come to credit side. By joint venture account, material rupees 2 lakhs, cement rupees 80,000, wages rupees 2 lakhs, license fee rupees 10,000, plant rupees 3 lakhs, total 7,90,000. By joint venture account rupees 50,000, that is a share in profit. Now come to debit side, there is one entry, amount received in advance to bank account rupees 5 lakhs. Now make total on both side, rupees 8,40,000 on credit side and same total will be on debit side 8,40,000, difference rupees 2 lakhs to bank account, balance amount rupees 2 lakhs. Shyam will prepare joint venture account and Ram's account. Let us see how the joint venture account and Ram's account will appear in the book of Shyam. In the book of Shyam, joint venture account with Ram. Now come to debit side. To Ram's account, material rupees 3,40,000, cement rupees 70,000, architect fee rupees 40,000, total amount 4,50,000. Now paid by Shyam to bank account, material rupees 2 lakhs, cement rupees 80,000, wages rupees 2 lakhs, license fee rupees 10,000, plant rupees 3 lakhs, total amount 7,90,000. Now come to credit side. By purchase account rupees 1,40,000, the plant taken by the Shyam. By Ram's account, contract price received rupees 12 lakhs. Make total on both side, that is 13,40,000, and there is a difference on debit side rupees 1 lakhs. This is known as net profit. This profit will be apportioned among Ram and Shyam in the proportion of 1:1. So 50,000 to profit and loss account, share in profit, and 50,000 to Ram's account, share in profit. You must have noticed that all debit and credit entries in the joint venture account will remain the same in the book of both co-venturers. Only particulars will change accordingly, but net profit will also remain the same. Now let us see Ram's account in the books of Shyam. In the books of Shyam, Ram's account, come to debit side, to joint venture account, contract price received by Ram rupees 12 lakhs. Now come to credit side, by joint venture account, material rupees 3,40,000, cement rupees 70,000, architect fee rupees 40,000, total amount 4,50,000, and profit by joint venture account, share in profit rupees 50,000, advance amount by bank account rupees 5 lakhs rupees, make total on both side rupees 12 lakhs 12 lakhs. There is a difference on credit side rupees 2 lakhs by bank account, balance amount received from Ram. Here also you must have noticed that Shyam's account shows a credit balance of rupees 2 lakhs, means Ram has to pay rupees 2 lakhs to Shyam's in the final settlements, which is paid by Ram. In the books of Shyam, Ram's account also shows the balance of rupees 2 lakhs, which is a debit balance, means Shyam has to receive rupees 2 lakhs from Ram, which is received as a final settlement. Hence, it is important that the balance of the other co-venturers account will be the same in each co-venturer's books. We can also say that by preparing a joint venture account and other co-venturers account, arithmetic accuracy can be ensured. Now let us take another illustration number 5 of the same method. Ramesh and Suresh entered into a joint venture to purchase and sell hosiery goods. Profit and losses were to be shared in the ratio of 2:3. Ramesh financed the venture and Suresh undertook the sales on a commission of 10% on the sales proceeds. Ramesh purchased goods to the value of rupees 2,50,000 less 5% trade discount, paid freight of rupees 7,500, advance rupees 6,000 to Suresh to meet expenses. Suresh expended for carriage rupees 1,500, rent rupees 3,000 and advertisement rupees 1,000. Sales made by Suresh amounted rupees 4,45,000. Remaining unsold goods costing rupees 15,000 were retained by Suresh and those were charged to him at a price to shows the same rate of gross profit without charging any expenditure as that made on the total sales. Excluding those goods taken, prepare the necessary ledgers account in the books, assuming a separate set of books is not maintained. The balance amount owed or owed to the co-venturers was settled. In this question, the new point is the valuation of closing stock. The question says that remaining unsold goods costing rupees 15,000 were retained by Suresh and those were charged to him at a price to shows the same rate of gross profit without charging any expenditure as that made on the total sales, excluding those goods taken. Let us first calculate the rate of gross profit on sale. Cost of goods sold is equal to total goods purchased minus unsold stock. Goods purchased rupees 2,37,500, unsold goods rupees 15,000. So, cost of goods sold is equal to rupees 2,37,500 minus rupees 15,000 equals to rupees 2,22,500. Gross profit is equal to sales minus cost of goods sold. Total sales rupees 4,45,000 minus cost of goods sold rupees 2,22,500 is equal to total gross profit 2,22,500. So, percentage of gross profit on cost is equal to gross profit divided by cost of goods sold multiplied by 100 is equal to gross profit 2,22,500 divided by cost of goods sold rupees 2,22,500 multiplied by 100 is equal to 100%. So, value of unsold stock taken over by Suresh at the same gross profit 100%. 15,000 cost price plus 100% gross profit is equal to 30,000. Here it is important to note that as per arrangement, no expenses incurred are to be added for the calculating cost of goods sold. If such instruction was not given, we have to add direct expenses incurred for acquiring goods, excluding sales expenses and recurring expenses like go down rent and go down insurance. In the next question, we will discuss the same point, how the direct expenses are included for the valuation of cost of goods sold. Now, let us see the ledger accounts in the book of Ramesh. Ramesh will prepare joint venture account and Suresh account. In the book of Ramesh, joint venture account with Suresh. Now, on debit side, to bank account, good purchased rupees 2,50,000 less 5% trade discount is equal to 2,37,500 plus freight paid rupees 7,500, total cost 2,45,000. Now, expenses paid by Suresh to Suresh account expenses carries rupees 1,500, rent rupees 3000, advertisement rupees 1000, total amount 5500. Now come to credit side. By Suresh account, sales rupees 4,45,000, and on this sales there is a 10% commission given. So come to debit side, to Suresh account, commission 10% on sales rupees 4,45,000 multiplied by 10% is equal to 44,500. Now come to credit side. Once again there is one transaction which is closing stock taken by Suresh account rupees 30,000. Now make total on both side, that is 4,75,000 on credit side, same amount will be on debit side. So there is a difference on debit side rupees 1,80,000. This is a net profit, and this profit will be apportioned among Ramesh and Suresh in the ratio of 2:3. So a 1,80,000 multiplied by 2 by 5 is equal to 72,000. This is a share of Ramesh. It is transferred to profit and loss account, and to Suresh account 1,80,000 multiplied by 3 divided by 5. So amount 1,08,000. Let us discuss how Ramesh will prepare Suresh account in his book. Now Suresh account, particular amount, come to debit side. To joint venture account, sales made by Suresh rupees 4,45,000. To joint venture account, closing stock taken by Suresh rupees 30,000. To bank account, advance given to Suresh rupees 6,000. Come to credit side. By joint venture account, expenses paid by Suresh rupees 5,500. By joint venture account, commission payable to Suresh rupees 44,500. By joint venture account, shares in profit rupees 1,08,000. Now make total on both side 4,81,000, that is on credit side 4,81,000. There is a difference on credit side 3,23,000. By bank account, balance amount received from Suresh. Now let us prepare the necessary ledger account in the book of Suresh. In the book of Suresh, joint venture account with Ramesh. Now debit side, expenses paid by Ramesh. To Ramesh account, goods purchased rupees 2,50,000 less 5% trade discount is equal to 2,50,000 minus 12,500 trade discount is equal to rupees 2,37,500 plus freight paid rupees 7,500. Total amount 2,45,000. Now expenses paid by Suresh. To bank account, expenses carriage rupees 1,500, rent rupees 3,000, advertisement expenses rupees 1,000, total amount 5,500. Now come to credit side. By bank account, sales rupees 4,45,000. Now 10% commission on this sales. To commission account, debit side 4,45,000 multiplied by 10% is equal to 44,500. Now come to credit side. By purchase account, closing stock taken over rupees 30,000. Now make total of both side, that is 4,75,000 on credit side and on debit side same amount. So there is a difference in debit side rupees 1,80,000. This is known as a net profit. This net profit is apportioned among Ramesh and Suresh in the proportion of 2:3. So Suresh portion is 1,80,000 multiplied by 3 divided by 5 is equal to 1,08,000, and Ramesh share in profit 1,80,000 multiplied by 2 divided by 5 equals to rupees 72,000. Ramesh account, debit side particulars amount, credit side particulars amount. Now come to credit side. To joint venture account, expenses paid by Ramesh rupees 2,45,000. To joint venture account, share in profit rupees 72,000. By bank account credit side, by bank account advance received from Ramesh, so rupees 6,000. Make total on both side 3,23,000. So, there is a difference on debit side rupees 3,23,000 to bank account balance amount paid to Ramesh. Let us end this session. In this session, we did the practice of how the ledger accounts were prepared in the book of each co-venturer, discussed which journal entries are passed in the book of co-venturers when an advance is given by one co-venturer to another co-venturer, how to find the valuation of closing stock when the rate of gross profit on cost is to be added without considering any expenses. I hope now you have a better understanding of the first method of joint venture when accounts are maintained by partners in their own books of accounts. In the next session, we will discuss further practical questions with more calculation of valuation of closing stock, where we will include proportionate direct expenses in cost of goods sold. Thank you all. Keep on practicing and revising the topic to have more confidence and command over the topic of joint venture. See you in the next session. Thank you.